Well, hi there. How are you doing today? You know what? If you're a buyer or a seller in today's market, what should you know about FHA financing? Well, it turns out somebody's been telling lies on FHA. So let's get to the bottom of it. And hey, thank you so much for tuning in today. My name's Luane and I'm with the Glover Agency in Fenton, Michigan, and I love making videos about Fenton, Grand Lake, Clarkston, Holly, and everywhere around mid-Michigan, and all about the real estate market in mid-Michigan as well. And if you're into that kind of freaky stuff like I am, then you're going to want to be sure that you hit like and subscribe so that you'll get a notification whenever we drop a new video and we get to connect more frequently. And thank you so much for tuning in. And also, I am a full-time realtor. I don't just make videos all the time. So of course, if you're looking to buy, sell, or build in the next 6 days, 6 weeks, or even 6 months, I'm here to help you. Just reach out. My contact info is below. So let's get this baby started. Myth number one about FHA loans is that they are only for people with bad credit. And although home buyers with credit scores of 580 or higher can get an FHA loan, in some cases with scores as low as 500 if they're putting 10% down. FHA loans are not just for people with bad credit. In fact, the vast majority of people applying for FHA loans have a score of 600 or higher. Back in 2021, Fannie Mae reported that 41% of FHA borrowers had scores between 650 and 7, and then another 21% had scores between 7 and 750, and less than 2% had scores below 600. So how did this rumor get started? Well, the Federal Housing Administration created the program to help homeowners to make home ownership more accessible to people who did not qualify for conventional loans. Because the government issues these loans, lenders are able to offer them to borrowers who don't meet the conventional 620 credit score threshold. Lenders are also able to be more flexible on the debt to income ratio, or DTI, and can accept low down payments of 3.5%. And even better, borrowers can use gift funds or down payment assistance towards their down payment or their closing costs. And all of these features make FHA loans accessible to a wide group of people. Myth number two, FHA loans are only for single-family homes. No, not true. Actually, FHA loans are available for properties with up to 4 units, which is great news for you if you've been thinking about a way to make some extra money. Because if you buy a multifamily unit property with an FHA loan, you must live in one of the units, but you're allowed to rent out the others. Some of these qualifying family groups can include a duplex, a triplex, a fourplex, an apartment building, or a home that is legally divided into 4 legal units. And of course, you can also use an FHA loan to buy a standalone single-family home. You may also be able to purchase a townhome, a manufactured home, or a condo as long as the condo is HUD approved. Myth number 3, only first-time home buyers can use FHA financing. Not true. FHA loans are great options for first-time home buyers because of the low down payment requirement and lenient borrowing criteria. But there's no rule against home buyers taking out FHA loans or using FHA loans multiple times. FHA loans are great options for first-time home buyers, but there's no rule against repeat home buyers taking out FHA loans or using FHA loans. The FHA requires that the property you are buying will be your primary residence. Whether you are a first-time home buyer or a repeat home buyer, generally speaking, the FHA does not allow borrowers to have two FHA loans at the same time. But there are some exceptions, such as if you are going through a divorce and you have to move out of your house, but you want to talk with your lender about their programs and what your specific financial circumstances are. Myth number 4 is that you need a W-2 to get an FHA loan. If you are self-employed or you receive non-income or non-employment income, such as SSI or alimony, you may not have a W-2. And that's okay. You just need to document all income sources that will be used to qualify for the loan. And these things, and again, that might include self-employment income, Social Security, disability insurance, supplemental security income, child support or alimony, and even your investment dividends. Myth number 5, mortgage insurance lasts the entire life of an FHA loan. Well, this one depends. Here's the deal with mortgage insurance. All FHA loans require upfront and annual mortgage insurance premiums, or MIP. This looks like an upfront cost of 1.75% and then an annual cost of 0.85%. This is based on your loan amount and your down payment. Most FHA borrowers put down less than 5% on their mortgages. And at that down payment level, you are going to be required to have MIP on the life of your loan. However, if you put down 10% or more, the annual MIP requirement ends after 11 years. So let's say that you want to take advantage of the low down payment option, but you want to avoid paying PMI for the lifetime of the loan. Well, once you have at least 20% equity in your home or whatever property it is you're financing, you can refinance out of your FHA loan to a conventional loan, which only have a private mortgage insurance or PMI requirement on down payments of less than 20%. So again, when you have 20% home equity, or if you're putting down the equivalent of 20%, you're then able to move into a conventional loan. And this is one of the main reasons why conventional loans are popular with people who have larger down payments. And there's no PMI at all if you're at a 20% equity position or greater in your property. And you know what? These days, most people only put down about 6%. That's the average. Myth number 6. If I'm denied at one lender, every FHA lender will deny me. Well, that's not true. Each lender has its own requirements for the type of borrower that it will approve for an FHA loan. The FHA sets guidelines, but mortgage lenders can have their own criteria, known as overlays, on top of those requirements. Some lenders are just simply stricter than others. And that often has to do with what they're doing with their loans after they close. Some lenders hold their loans in-house and service them, and those lenders generally have more leeway in the decisions that they make. Conversely, other lenders close their loans and then sell them to a company that will service them and take over. So if you've ever bought a home and you had a lender and then all of a sudden you got a notification that you had to pay another lender, this was probably why. And when you have people who are investing in these mortgages, they often have stricter criteria. So, because the lender themselves cannot sell these loans if they're not good quality loans, if they're high risk loans, for instance. So it's really important to speak with your lender about the requirements that they have and your personal financial circumstances before applying for your FHA loan. But just because one lender doesn't approve your application doesn't mean that another lender will do the same. And here's a little tip for you. Choose a few lenders before you start the home buying process, and then apply with all of them within a 14-day window. Every time you apply for credit, a lender will do a hard credit inquiry, which shows up on your credit report and temporarily lowers your credit score. However, if several mortgage lenders pull your credit within this 14-day window, those inquiries will only count as a one hard inquiry instead of each request lowering your credit score. Myth number 7. FHA loans take too long because they have to go through the government. Well, that's just not true. FHA lenders are authorized to approve and close FHA loans without getting approval for each individual loan. And in theory, they could close as quickly as any other loan. However, there can be delays due to the FHA appraisal process. Lenders will require an appraisal for all loan types to determine the market value of the property and whether or not it is in sound condition. FHA has stricter property requirements to which their appraisers must adhere. If they flag something for repair before the loan can close, you're going to need to work with the seller to get the item fixed. And then that can be a delay. Myth number 8, FHA loans have stricter appraisal guidelines. Weren't we just talking about that? A lot of hype has built up around FHA appraiser guidelines, but most properties will qualify for FHA financing. The FHA approved appraisers will evaluate the overall condition of the home. They want to make sure that it is structurally sound, that there are not any obvious hazards, and that it is a safe and livable property. They will also determine the fair market value of the home. Lenders cannot approve loans for more than the home is worth. According to the FHA guidelines, if an appraisal comes back lower, you'll need to negotiate with the seller on the price. And a lot of hype has been built up around these FHA appraisal guidelines. These appraisals spook some sellers because they worry that the sale will not close, and also that they're going to have to put more money into a property that they're trying to get out of. If you work with a real estate agent who is familiar with FHA loans, they can help you find a home that is likely to pass the FHA appraisal. They will also have some sense of the local housing market and whether a home is priced way above its value. And your agent cannot say exactly what the home appraisal is going to come in at, but they can at least give you some guidance and guidelines on the likelihood that the property will be cleared by FHA. And it's important to note that many appraisers do both FHA and conventional. They're not two different types of appraisers. So they do both. They just have an additional certification to do FHA appraisals. So generally speaking, you're not going to get that much difference between the appraisals. I have closed many FHA loans in my career. And for both buyers, I've also had sellers who have accepted them using FHA financing. And I honestly can count on one hand how many times I've had properties flagged for problems with FHA that they wouldn't pass. And none of these items were very expensive. There was one that comes to mind that was $800, but that was a whole different situation with a foreclosure and so on and so forth. And there was a pipe that broke. So that was a little bit more expensive. But most of them are relatively inexpensive repairs. And there is a place on the purchase agreement where a buyer, when they make their FHA offer, can say that, they would like the seller to pay for repairs up to a certain amount. So it could be $300, $400, or $500, and that's negotiable. So if you, the seller, don't agree with that amount, of course, you could counter back on that when you're negotiating the offer. Another thing that is important to know about FHA appraisals is that they will stay with the property for 6 months. So if you're a seller and you put your home on the market and you get an offer from an FHA buyer and your appraisal comes in lower, then that appraisal will stay with the property for any other FHA buyer. So sometimes when this happens, buyers are like, well, that's it. I'm not taking any more FHA buyers because that appraisal was too low. Well, again, let's remember that FHA appraisers are often also conventional appraisers. And realistically, the difference that they're going to have on the value of your home isn't going to be that different. You might make $1,000 or $2,000 more on it, but most appraisers kind of come in the same range because they're using the same data to comp your house out. So I guess you could take your chances, but it might be best to work with the seller that you have at hand. And if the appraisal is coming back a little bit lower than what you'd like, then try to negotiate that out. Maybe there's another way to work through it. But if you do put it back on the market and another FHA buyer comes in, that same appraisal is going to work. And the only way that you can absolutely avoid that is to not accept FHA. And a very large segment of buyers do use FHA mortgages. So it's kind of a catch-22, isn't it? And I have to tell you, I've only had, in all the time that I've been in real estate, which is over 15 years now, I've only had maybe 2 appraisals come back on homes that I sold that were low. And one of them was not an FHA. The other one was. And the reason that it was low is that the appraiser was from out of the area. And it was like a site condo. The homes were like a site condo. They actually owned the property. They cared for and maintained their own land. But they did have a condominium association. And this particular appraiser did not include the land value in the home value. So once we were able to look at the appraisal and understand what had happened, we were able to go back and show them subsequent properties that had sold and that the value was included, and then it was all better. Myth number 9, FHA loans allow the lowest down payment. Actually, this is kind of a trick question, because it's not true. A very low down payment with an FHA loan of 3.5% being the very minimum, VA loans and USDA loans both allow eligible buyers to buy homes with 0 down. But of course, you have to be eligible. For instance, VA loans, you have to be a veteran. And an USDA loan, you're going to have to deal with some income limitations because you can only have so much income if you're using a USDA loan, and your property has to be within certain boundaries or USDA rural development areas. And that usually means that you're going to be in a more rural or suburban area. I can tell you my daughter and her husband purchased a home on a that was actually advertised as rural development. Well, when I showed them the home, I knew right away that the boundary was on the opposite side of the road. So what happens is they say, this road is anything that's, east of this road is rural development. Anything that's west of this road is rural development. Well, I knew that we were at the far west boundary in that area, and their home happened to be on the east side of the road. So they did not qualify for rural development, but they wanted the home, so they had to come up with a 3.5% down payment so that they could get the home through FHA. We tried to get them no down payment, but they fell in love with a home that was across the street, and that counts. They do not consider that. I personally don't agree with that. I think if your home fronts the road that is the boundary, that you should be able to get USDA. But they don't agree with me on that. So that's why I guess I don't work for the government. And there are some conventional loan programs that will allow you to purchase a home with just 3% down. But fortunately, the FHA allows borrowers to use gift funds and down payment assistance that they can use toward their down payment and closing costs to cover all upfront costs. And, I've actually had FHA buyers and USD rural development buyers walk away with a check in their hand for, maybe a couple $100 because that's what was owed to them when all was said and done. I kind of like that idea, right? So you could get an FHA loan with no money down if you have a family member or friend or an employer who will gift you down payment assistance. Myth number 10, FHA loans have higher interest rates than conventional loans. Well, you know what? That is just not true. As a matter of fact, many times FHA loans can be about 0.5% less than conventional loans. And if you have a credit score that is 679 or lower, and you qualify for both a conventional and an FHA loan, you may want to go for the FHA loan because credit scores under 800 cause interest rates to go up when you're purchasing. Going with an FHA loan gives you a better rate and money saved over the life of the loan. How much money is saved? Well, let's assume that your credit score is 640. And due to loan levels, price adjustments, your interest rate on an FHA loan may be around 0.50% lower than on a conventional loan. According to mortgage rate modeling software, I know that our preferred lender was sharing with us earlier this year that FHA loans were a full percentage point below what many conventional loans were going for. And that can make a big difference in your payment. Oh, and remember that there are no income limits for FHA loans. Even if you are a high earning household, you can still qualify for an FHA loan. This is one of the major advantages over a USDA loan. Now, that is also a government loan, but it has an income limitation. Borrower's income must be equal to or less than 115% of the area income where the subject property is located. Additionally, USDA loans are only available in qualifying rural areas, as we talked about before. You cannot get an FHA loan if you have student loans. Wrong. Now, this FHA application changed back in 2021. So how it used to work is if you had a student loan, you might have had like a payment of, I don't know, $500 a month. But if that was on a $100,000 balance, the lender had to use 1% of the balance of your loan to count towards your debt to income ratio. So let's say that you decide to purchase a home, you have $100,000 in student loans, your current payment is $500, but your balance is $100,000. So prior to 2021, the lender had to add $1,000 to your debt to income ratio, which doesn't necessarily put you outside of the limits. It would just depend on your income. But for a lot of people, it might have made their debt to income ratio way over. So in 2021, they changed that, and buyers benefited, and they changed this to the buyer's benefit. So it didn't matter what your payment was, it actually had to do with what your balance was. Now the FHA rules allow lenders to use borrowers' actual monthly student loan payments, and if they are on the income-based repayment plan and their payments are more than $0, otherwise they can use 0.5% of the loan balance to calculate their monthly DTI. For someone who has $100,000 in student loans, their lender would count only $500 rather than $1,000 against their DTI. Myth number 13. You can't get an FHA loan if you have had a bankruptcy or a foreclosure. That's wrong. And I learned this back when I very first started in real estate, because it was right after the 2008 crash, and there were many borrowers who had had previous foreclosures or bankruptcy due to job loss, etc. So if you have had a bankruptcy and it's a Chapter 7, it's a 2-year wait. If it's a Chapter 11, you may qualify within 1 year of your repayment plan, and you have to show that you've been making your payments on time, as agreed to. If you've had a foreclosure, it's a 3-year wait. And there are some exceptions if you can prove that the circumstances were beyond your control. An example of this might be that maybe you got a divorce and your ex-spouse got the house, but it went into foreclosure. You were not living there, you were not responsible for the payments, but your name was still on the house. If you can prove that was not within your control, then you may be able to get around that. But still not too bad. Many places you may have to wait 7 years, and you're going to need to document everything. And finally, most homeowners won't accept an offer that states that you're using an FHA loan. Sellers sometimes prefer conventional financing or cash offers, but FHA offers can be successful. I have won many bids with FHA buyers. A lot of times it's just a matter of either talking to the lender, having the lender reach out to the seller's agent to explain the strength of the buyer, maybe why it is that they're using FHA. Some buyers, if they can, get qualified for both, and then they try to use one, but they can always go conventional if they had to. And you can really increase your chances of getting an FHA loan accepted if you're using a realtor that understands all of the ins and outs of FHA financing and can help to assure the listing agent that the client is a good credit risk. And I was just thinking too, as I was thinking about this, one really weird FHA repair I had to have done. I had a buyer or a seller that was selling a home, and there was an above ground pool that had a deck built up to it. And when she purchased the home, her son was, I want to say, like 8 or 10 years old. And she lived there for several years. And when she went to sell the home, the FHA buyer came in and everything was fine. However, when they did the appraisal, they flagged the fact that the pool did not have a gate in front of it. So they felt it was a safety hazard. So even if you have an above ground pool, if it was right, like built into the deck, so when you walked down the deck, you could go right into the pool, they wanted to have that closed off. Well, of course, this was a single mother. She didn't have any building skills, and it would have cost her plenty to put in a whole gate and everything. So what ended up happening is the buyer themselves had some building skills, and they came over and put up a temporary gate or fence around the pool, which helped it to pass the FHA inspection, and therefore we were able to close on time, which was fabulous. So there are really many ways to skin a cat, and we just have to get creative sometimes in how we do things. And most FHA buyers are okay with that. Well, I hope that you enjoyed the video today. And if you found value in it, I hope you'll hit like and subscribe. And please share the video with anybody that you want. And I also love to hear your comments. If you have any thoughts or questions, put them down below, and I'll be sure to get back to you. Thanks for tuning in, and have a great day.